Okay, chapter 14 is all about bonds. Bonds are financing your company with debt. So there are certain organizations that need money, all of them. Some of them finance through selling equity. So in chapter 13, we learned about corporations, about an entrepreneur that needs money, they've got an idea, they need to collect money. Some of them sell ownership in their company in the form of stock, and they have lots of owners that all get to have a small voice in what the company does. The other way to get money for your company is to do what the book calls long-term debt financing. What that is in most scenarios is a bond or a payable of some sort. Chapter 14 is almost all about bonds. The idea of a bond is that a company says, give me your money. Usually every 6 months or semi-annually, they give you an interest payment. And then once the bond is done, when the bond comes to maturity, then they give you your money all the way back. So if I was to ask you, can I please have $10,000? Or let's make it simple. I'm going to sell a bond to you for $1,000. I'm going to pay you 6% interest, and I'm going to pay that out as an annual 6% interest. And then at the end of my 10-year term, I'm going to give you that $1,000 back. It means that every half of a year, I'm going to give you $30. That's half of 6%. That's 3% every 6 months. So if we look at a bond on the timeline here, I ask you for money, and I say, okay, I'm going to give you $1,000. Or you're going to give me $1,000. Now, for the next 10 years, that's the life of the bond, I'm going to make 20 payments to you of $30 a piece because there is a 6% interest, which means every year you make $60 off of giving me that loan. So every year, so this would be called a par value of $1,000, a maturity of 10 years, and 6% annual interest, which is paid out semi-annually, which means twice a year you receive $30. So after all is said and done, and you have, first you give me the $1,000, and then 20 times, don't count that because I'm sure I didn't make 20 of them, I pay you $30. $30 every single 6-month period, and then at the end of the 10-year maturity, I give you back your $1,000. Bonds are another form of investment. They can sell in two ways. They can sell at a premium, which means everybody wants them. They're a good value, so they'd be willing to pay $1,200 and take the interest payments knowing that I was going to most likely give them the $1,000 back no matter what, so there's a value. If I was a little bit of a shadier company or one that didn't have a great plan or financials, that bond might sell at a discount. And I might ask for $1,000 and I might only get $900 of the bond. That means it's sold at a discount. I still have to make the payments and I still have to return the money, but it pays at a different price. Let's talk now about the accounting structure of things. Let's go to the general ledger, where we all avoid it, but let's try to do our best to just make it really simple. So the first thing we do with a bond is if Matt DeYoung Company says, I want to get some more money, we're going to release a bond. I'm going to go there and I'm going to say, okay, the first thing I need to do is issue a bond. The book will call this issuance. So we'll do 2-1, and this is called the issuance of the bond. We issue the bond for the sake of keeping things simple. It's $1,000. What do we get? We get $1,000 of cash. That's the asset that comes into us. So we're going to debit cash, and we are going to credit what? We're going to credit a bond payable. A bond payable is what we're going to owe to the investors. Bond payable. The accounting equation is let me clean this up a little bit. I just looked at the board and realized that I don't have everything perfect. So first we have the description, which is an issuance. Description, we're going to issue the bond. Then we're going to debit cash. and we're going to debit cash 1,000, and then we're going to have a bond payable of 1,000. So the accounting equation is all made right with the world. We've issued it over here, and then here's the look of our general journal. The next thing that happens, let's say in the world of bonds, the next thing that happens is we're going to pay out interest. What we do there is we're going to debit the category, and it's called bond interest expense. Bond interest expense. So in the scenario that I gave to you, it was $1,000 at 6%, which means if it's $1,000, there's a $30 debit here. And then we're going to have to credit cash because cash goes out of the company. $30 here. The final thing that happens is once the bond comes to maturity. So we have the issuance, we have paying out expense, and then we have maturity. That's when we go through and we just swap these two out. Now we're going to debit bond payable, and we're going to debit that at 1,000, and we have to give back the cash. I am certain this video will change your life. I'm thankful for those of you that spent the 6 minutes to stay around for it. I hope it gives you a better understanding of what we wanted to learn in this chapter. What I sent to you, the website zenwealth.com for bond calculators. If you make it into the world of finance and you need a refresher, having a little favorites icon or a bookmark on Zen Wealth's calculator will serve you well. Thanks for your time, and appreciate all of you.